Good afternoon, everyone. This is Brad Ward, the Director of Community Philanthropy here with the Council on Foundations. Thanks for joining us. We have Suzanne Friday here, our Senior Counsel and VP of Legal Affairs, to talk through some good old issues around corporate donors and lovely title here, when corporations come knocking, working with corporate donors and employer-related funds. So as I said, we have the good fortune of Suzanne joining us and myself, and we'll be here to take your questions and think through the conversation. Just a few quick housekeeping items. If you need any help throughout the conversation in the webinar, you can find the access the help desk, which is at the top right of your bar there on the toolbar. If you have any questions at any time that you'd like to submit for consideration, there's a pop-up questions box where you can type those questions for the presenter, and those will come to me, and I'll be sure to be monitoring those questions, and we'll try to field those throughout the conversation or at the tail end of today's program. So with that, I think we're going to jump right in to get the most out of the hour. So Suzanne, thank you for taking the time today to talk to us about corporate donors.
You're welcome, Brad. Thank you, and thank you all for joining us. This is our second this year of our quarterly Community Foundation conference call webinars, and the subject today, as Brad said, is all about corporate donors. When the corporations come to you as a community foundation and they want to start a fund or they need a scholarship fund, all these various requests that you might get from corporations, we're going to talk about the legal issues associated with them. And as you can hopefully see on the screen, I've laid out the agenda for the hour. We're going to start with who is a corporate donor, what are some fund options for corporate donors, when corporate donors want to fundraise for their funds, when they want to actively participate in the grant selection. We're going to talk a little bit about corporate donor advised funds and the legal restrictions there. We're going to also talk about a very popular topic, employer-related scholarship funds, and then round out the hour with a little bit about corporate employee assistance and disaster and hardship funds. So with that, we'll move right along. Oh, there's the disclaimer, legal disclaimer. You guys can read that. Okay, so I think the first thing to start with, and it seems like a very basic question, but I think it's important, is to understand who is a corporate donor and understand who your donor is. There may be times when you are approached by an individual who wants to set up a fund. He may own a company or run a company, but it's the individual that is interested in starting the fund. That's not really a corporate donor. It's when the corporation wants to set up a fund as the corporation, and a corporation is a legal entity in its own. It's often referred to as a person in the tax code. So your corporation in this case is your donor, and because of that, you may be dealing with a full board, you may be dealing with multiple staff people at that corporation. You're not always going to deal with one individual. But that's the first kind of threshold question to answer. Is this a corporate donor? Is this the corporation that is wanting to set up the fund? Or is it really just an individual who happens to own a corporation? Once you've determined that, yes, we really do have a corporate donor, it's important to know who has authority to act on behalf of the corporation. Just like at your foundation, there are only certain people that have the ability to act on behalf of the foundation to do things like sign contracts or commit the foundation to grants and things. Corporations are the same way. They're going to have certain people that have that authority. Most larger corporations are governed by a board, and the board can delegate to staff the authority. But it's very important for you guys to know who you're dealing with as far as the authority to sign a fund agreement, to deliver corporate contributions to the fund. You want to be very clear on that so that you don't get into any messy contractual issues about dealing with someone who did not have authority. The next point I want to make is that grant making or the fund purpose can be tied to interests of the company. That's not inappropriate. In fact, it's very common for corporate donors to tailor their charitable giving in a way that naturally flows from the activities of the corporation. Simple example, a computer company may want to set up a fund to promote computer literacy and education in that field. While, yes, it could conceivably lead to people buying computers from the computer company, that's certainly not the purpose of the fund. The purpose is the charitable education, and that's what the grants would be funding. So don't be afraid of those type of connections. They're again common in the corporate world, and certainly not illegal in most cases. The next point I have on this slide is a note about limited liability companies, partnerships, and S corporations. All of these types of business entities are considered pass-through entities, that the owners that own the business claim the business income and pay the taxes themselves rather than the corporation at the corporation level paying taxes on the corporation's income. This gets a little bit tricky in what you're dealing with. A corporation that's incorporated and has shareholders, that's actually a simpler structure to deal with than LLCs and partnerships and S corporations. So I'm not going to go into detail about what each of these business entities are like, but certainly if you have a donor that's coming to you and happens to be an S corporation or happens to be an LLC, please reach out and give me a call and we can talk about some of the special considerations in that area. The next consideration when you're approached by a corporate donor is deciding whether you want or they want an endowment fund or a pass-through fund. In the corporate world, there are many corporations have set up their own corporate foundations, and most of the time these are private foundations because they are funded solely or primarily by contributions of the corporation. And many corporations are not endowment type, many corporate foundations are not endowment type foundations. They are vehicles where the corporation contributes money and grants go right back out for the charitable purposes that the corporation is interested in. That's perfectly fine also, and if you are dealing with a corporate donor who's used to that type of structure, they may be requesting from you a pass-through fund rather than an endowment. Of course, as community foundations, we all know the value of endowments and the great work that endowment funds can do. But again, this is not something to shy away from if your corporation, your corporate donor is looking for a pass-through fund and they plan to put money in every year but want that money paid out in grants. We talked about determining the primary contacts or advisors. So if, for instance, your corporate donor wants a field of interest fund or even a donor advised fund, you're going to need to know exactly who the advisors are going to be, who your contacts are going to be for questions about grant making. That's very important. They can be designated by position. For instance, the CEO can always be your contact, and the CEO may change from year to year. But they can also be designated by name, the name of an individual, and there's nothing wrong with that. But there should be some understanding about what happens when that individual is no longer with the company. So the next slide, we go into fund options for corporate donors, and pretty much like any type of donor, you've got the same options. They can contribute to your unrestricted funds. Hopefully you have unrestricted funds where you as a foundation can make grants as you decide, and corporations can contribute to that if they don't want to set up their own fund. They can also establish a fund and even name it for the corporation, but give you as the foundation the complete discretion on what kind of grants you make from that. They can set up a designated fund, designated for certain charitable organizations that they want to support. they can set up a field of interest fund. And again, the field of interest can be something that's tied to the work of the company. For instance, a pharmaceutical company might want to set up a field of interest fund to support healthcare organizations. And field of interest funds can have advisory committees or not. The grant decisions can be made internally at your foundation, or you can utilize an advisory committee. They can set up scholarship funds either for their employees, which we'll talk about in a few minutes, or just for students in the community. And then lastly, they can set up donor-advised funds, and we're going to talk about donor-advised funds specifically a little later. But remember, the corporation is your donor, not individuals, and so the corporation has the privilege of providing the advice. Now, naturally, they're going to need to designate a person to talk to and to communicate that advice. So that's a little different with donor-advised funds that are held by corporations. And this next slide I put in here because I think it's important for you guys as community foundations to understand why community foundation funds can be preferable to corporate foundations. I mentioned corporate foundations already, and many, many corporations in the United States have set up charitable foundations of their own. But most of those corporate foundations are private foundations and are therefore subject to a lot of the private foundation rules, including the self-dealing rules, which can be very strict and limit certain transactions between the foundation and others. And as a public charity, you guys are, the community foundation is a public charity. All of your funds also enjoy public charity status, and so a corporate charitable fund at your foundation would also enjoy that public charity status and therefore not be subject to the private foundation rules. We all know that setting up a fund at a community foundation can be a very inexpensive way to get started in charitable giving. The setup and the maintenance can be very economical as compared to a separate corporate foundation. Corporations also oftentimes very much need access to your community knowledge and the experience of your staff to help guide them in their charitable giving, particularly if a corporation has not done a lot of charitable giving in the past and are now really getting into it. Your staff and your knowledge can be really invaluable to help them do that in a very smart way. Pooling the assets that they contribute to you with your other assets for investment purposes, and we all know the advantage of that. And community foundations are well regarded in the investment area. And then if the company is ever sold or merged with another company, if the fund is already at a community foundation, there's no need to worry about what to do with the corporate foundation. There's not a separate corporate foundation that has to be unwound or has to be transferred or terminated. The fund at the community foundation can live on beyond the company, and that's another advantage. This next slide I wanted to talk about a little bit about what the corporation may want to give you as a contribution, as a charitable contribution. Corporate donors are not always going to be giving you cash. They are sometimes going to be giving you stock and ownership interest in the company or other companies that they may have as investments. They might try and give you in-kind contributions of products. The important considerations for you guys in setting up a fund at a community foundation is that the fund have assets which provide some income, some liquid amounts that you can spend. There's no sense in taking a contribution of stock or other assets which you can't convert to income or to cash that can be used for grant making. And this leads to my comment about watching out for material restrictions imposed by the donors. So for instance, as an example, corporation wants to set up a fund and wants to give you corporate stock, but they also want to make sure that you don't sell it for whatever reason. There's some business reason they don't want you to sell that stock out on the market, and they ask you to continue to hold that stock. Well, if that stock is not throwing off dividends or producing any kind of income that you guys can use for grant making, that stock is not going to be very helpful for your charitable work. And the IRS defines a material restriction as a condition or restriction that prevents you from freely employing the assets in your charitable mission. So that's something to be aware of when a corporate donor comes to you and wants to contribute assets that aren't easily liquidated or are not producing income. Real estate can also be gifted to the Community Foundation to help establish a corporate fund. But again, that real estate either needs to be able to be sold and converted to liquid assets, or it needs to be income producing so that you're getting some income that you can make grants with. Corporation, well, a business entity that is an LLC, a partnership, or an S corporation may also inquire about gifting you interest in those type of businesses. And this also opens up a little can of worms. I wouldn't say a big can of worms, but a little can of worms, in that it's different from a gift of stock. A gift of a business interest, such as an LLC, a partnership, or an S corporation, means that you guys are a part owner of that business. And instead of getting a statement at the end of the year, a 1099 for the dividends that is paid by the corporate stock, you are going to get a K-1 statement from the accountants showing your share of the income in the business. And so that leads to kind of a very simple threshold question: is that the right type of asset for you as a community foundation to hold? Do you want to be a co-owner in a business like that? Are there liability concerns with being a co-owner in a business like that? These are the questions you need to be asking your corporate donors if they're approaching you with this type of asset that they want to contribute and put in a fund. Many businesses in these forms will also have agreements among the members or the partners. Even corporations can have shareholder agreements which restrict the co-owners from selling or transferring their interest to others without the permission of the other partners. So for instance, you're offered an interest in an LLC, but there's an agreement among the LLC members that says if anyone ever wants to sell their LLC interest, they have to first offer it to each other, and sometimes the selling price is even set ahead of time. So you need to be very aware of that, because those types of agreements can pass on to new owners, and if you receive an LLC interest as a gift and you accept that, you may be subject to that type of agreement. It's not illegal and it's not improper to take an LLC ownership interest subject to a pre-existing agreement. You just need to be aware of it. It can also sometimes be helpful, because then that automatically creates a market when you're ready to sell the interest. And that, I do want to stop for a minute and make a note about prearranged sales. I've had questions here at the council from community foundations with donors who want to contribute a business interest, and they've actually already prearranged the sale of that interest to someone else. The IRS has issued some guidance on these prearranged sales and can deny the charitable tax deduction to the donor if there is a prearranged sale in place. As a community foundation, you're probably not going to want to help facilitate that. And again, the primary risk is for the donor, but a prearranged sale would be evidenced by any written documentation or even oral agreements that there is a promise to sell the stock or the business interest to someone else prior to the gift to the community foundation, and then the expectation that you as the community foundation follow through with that sale. There are many reasons why at the last minute, a donor may prefer to gift the business interest to a foundation and then have the foundation sell it. But again, you guys don't want to be involved in these prearranged sales because the IRS has said that those types of gifts do not have the necessary donative intent to earn a charitable tax deduction, and there can be some negative consequences for the donor in that case.
And Suzanne, the real gist there is that it's about the expectation, it's about the prearrangement that you have no control over.
Right.
It certainly can be valuable and useful if you're utilizing the sale of a farm or you're utilizing a small business, that they perhaps know the landscape and market, and you have some direction that you can see a viable sale and a viable outcome that you yourself as a foundation may not
right.
privy to. But the key is that there is no way, shape, or form that's required, restricted, and so forth.
Right. And that's a great point, Brad, because absolutely, if you're accepting a gift of a farm and the farmer, the owner, says, oh, and by the way, I know for sure my neighbor is interested in buying this, that's not a problem. He's making a suggestion to you. You're still in control of the sale or the potential sale. It's when there's a written agreement where he's already promised the neighbor to sell it, and then you're expected to honor that agreement. That's the prearrangement, and that's what you want to avoid. I've got a note in here about UBIT, unrelated business income tax. If you become an owner of a business because you've accepted business interest, you may have unrelated business income tax. Are you getting a question?
Yeah, I'm getting a question. So one of our attendees indicated that as long as the donor is made aware that the community foundation could still take a gift with a prearranged sale, there's no issue for the CF, and I think we're creating some confusion there perhaps with my question. So to re-clarify to our attendee, that the prearranged sale simply is not allowed in the sense. Could the donor have suggestions of opportunities for sale? Absolutely. But if there is already something written or oral, you're creating a dynamic that puts the donor at risk for their tax deduction as well as the community foundation for being involved in such an activity. So want to make sure we don't.
Yeah, and the way this scenario usually plays out is you have an individual, and let's take real estate because that's an easy example. They own a piece of real estate, and they've decided they want to sell it, and they find a realtor, and they sign a listing agreement, and the realtor finds a buyer, and they sign a contract to sell the house, to sell the real estate. And then the owner is talking to their tax advisor, and the tax advisor says, you know what, this actually is going to be more financially advantageous if you were to gift this real estate to charity rather than sell it yourself. If you sell it, you're going to have income to report, you're going to have taxes to pay. It's better if you gift it to a charity and let them sell it. So there's this financial business reason. There's already a contract in place, and all of a sudden the owner changes their mind about selling it and wants to donate it. So then they scramble to find a charity to accept the contribution, to accept the donation, and come to you as a community foundation and say, you know, I've got this property, I want to donate it to you, but there's already a contract to sell it, so I need you to complete the sale. That's what the IRS says is a prearranged sale and is not allowed, because in the IRS's view, the donor is not donating the property to you out of the goodness of their heart. The donor is doing this for a very specific business or financial reason. And it may seem kind of a silly distinction, but that's the view of the IRS, and that's what they said is going to harm the donor, and they could deny the tax deduction for that gift. So that's what you need to be on the lookout for, are pre-existing written contracts and agreements to sell, or binding oral promises. And when it comes to real estate, oral promises are usually not binding, but if there is an oral agreement to sell that could be enforced, you have to watch out for that. So hopefully that clarifies a little bit of the situation we're talking about. The last item on this slide is a note about donor advised funds and excess business holding rule. Donor advised funds are the only type of fund at your community foundation that would be subject to this rule. It's a special rule primarily for private foundations, but it says that the fund cannot hold more than 20% of a business, whether it's stock or partnership interest or an LLC interest, and that 20% counts not only what the fund has in it, but also what certain related persons also own. So your donor, if your donor owns 10% of a business and they want to give you 15% of the business, you have to add those numbers together. And if it's more than 20%, you're going to violate the excess business holding rule, and there are financial penalties involved. Now, the IRS does give you 5 years to liquidate that excess business holding, so you would have some time to try and sell the amount over 20% to keep you in compliance. But that's a special rule that would apply to your donor advised funds. And again, it does not apply to other types of funds. All right, so we're going to switch gears here and talk a little bit about fundraising. So you've got your corporate donor. They've decided on the type of fund they want, and they've put in a contribution and signed a fund agreement with you. Now they want to do some fundraising. They want to increase the amount of money in the fund, and they've got some ideas about fundraising for their fund. The first thing to do is check to see if you have a donor-initiated fundraising policy. And we here at the Council have a sample that you are welcome to look at, and reach out to me if you want to see that sample. But a donor-initiated fundraising policy, I think, is very important for community foundations. And Brad, did you have one at your foundation? Yes. So it's basically an internal policy that you adopt to talk about, one, whether or not you're going to allow your donors to fundraise for their funds, and if you are, what are the limitations? What are the ground rules for donor-initiated fundraising? Can donors engage in holding events, golf tournaments, galas, other types of events? Are you going to allow that, and under what circumstances would you allow that? With corporate funds, employee contributions are often a source of fundraising. The corporation may encourage their employees to send in contributions to the corporate fund, and there's nothing wrong with that. They shouldn't be requiring their employees to do that, but certainly you can accept contributions from the company's employees, and each employee then would get the tax deduction for that, and you would gift acknowledge the employees for their contributions. Now again, if you're a small community foundation with limited staff, you might want to be careful about this, because if the corporation announces to all their employees, their hundreds of employees, that they have a fund at the community foundation and they would love everyone to contribute, you may get bombarded with a bunch of small contributions and then have to send out gift acknowledgement letters to everybody. But it may be worth it, and maybe work that you can handle, but that's something that can come up with these corporate funds. Matching gifts are another idea that many corporations have and try and employ with their corporate funds. For instance, they encourage their employees to give directly, and then they promise to match every employee's contribution, whether it's dollar for dollar or 50 cents on the dollar, that kind of thing. Those can create some work on your part to track the employee contributions and remind the corporation of their match obligation. But again, it may be worthwhile and something to consider. When there is fundraising, you need to be aware of situations that may result in benefits back to the corporation. So for instance, if the corporation wants to hold an event to fundraise for their fund at your foundation, are they going to try and use that event for advertising purposes? There's nothing wrong with using a fundraising event to create goodwill or recognition for the company, but if you're starting to cross the line and they're using that opportunity to seek new customers and advertise, those are benefits that are flowing back to the corporation that you're not going to want to allow through your fundraising events. If they decide to hold an event, for instance, a golf tournament, and they want you to allow some free tickets to some of their favored customers, that's also inappropriate and not something you should be doing with a fundraiser for a fund at your community foundation.
Before we move on, one of the good questions from the field came about if a corporate fund is established as a donor-advised fund, as a DAF,
okay,
would gifts from a large number of employees change the characterization of the fund to something other than a DAF? So assuming that the DAF had already been established by the corporation,
right,
but it starts to receive employee contributions, does that change the nature of it being a DAF?
Yeah, that's actually a great question. From a legal sense, no. Most donor-advised fund agreements will say that other contributions from other sources may be received. And so there's nothing wrong with the establishing this as a donor-advised fund. The corporation is the donor. The corporation appoints the advisor, but then also seeks contributions or allows contributions from multiple employees. What you need to be careful with in this situation, though, is making sure that those employees, all of those employees who are contributing to the fund, understand that they don't have the same rights. They're not going to have the advisory privileges that the corporation as the donor, as the original donor, would have. Now, that's not to say that you can't work with the company to change the type of fund. You know, if that's the case and it starts receiving a lot of contributions from a lot of different sources, a lot of different employees, you may eventually want to morph that fund into something like a field of interest fund that may have a committee to advise, in which case you could, working with the company, engage employees to be part of the committee to help advise the grants. But just because it's getting lots of contributions from various donors doesn't automatically make it not a donor-advised fund. It's still a donor-advised fund as it was provided under the original fund agreement.
Thank you.
The last point on that slide was about proper gift acknowledgement, and this can sometimes get confusing if the corporation is holding a fundraiser and they're doing it, they're organizing it, they're managing it, they're doing it all themselves. They may aggregate all of the contributions and then give you one check, in which case you need to be very clear who your donor is in this situation. Certainly it's easiest to say the donor is the corporation and you give the gift acknowledgement letter to the corporation, one letter, one donor. But if the corporation is thinking that you will gift acknowledge all of the various employees and individuals who came to the fundraiser and gave money, that needs to be agreed upon up front before the fundraising event happens, so that you know for sure somebody's going to keep very close records of the attendees and their contributions, and then you can get the proper gift acknowledgement letter sent. Again, this is another situation where it puts a lot of work on your doorstep, so you have to decide whether or not you're even going to allow that. Okay, so we mentioned the field of interest funds with the committee. There are different ways that your donor, your corporate donor, might participate in the grant-making decisions. Of course, a donor-advised fund, if your corporation comes to you and decides they want a donor-advised fund, they are the donor. They are then allowed to appoint one or more advisors. They can appoint those individuals by name or by their position with the company. And that is a way for the company to participate in the grant-making decisions. Donor-advised funds, by virtue of being a donor, the donor has the privilege of advising you on the grants. If a donor-advised fund is not the type of fund they want, or for whatever reason is not going to work in a situation, a field of interest fund can also include an advisory committee which can include employees and other people associated with the company. The difference between a donor-advised fund and a committee-advised field of interest fund is really that the donor-advised fund, the donor appoints the advisor. The donor has the right and the privilege to appoint and decide who is the advisor. With a committee-advised fund that is not a donor-advised fund, you as the foundation must be in control and have the ultimate decision-making authority as to who those advisors will be. You appoint the committee. You can remove people from the committee. The committee, who sits on the committee, is under your control. Now, the company can certainly give you suggestions. They can recommend employees and staff and board members who might want to serve on the committee. But again, you as the foundation are in control, and that is why it's different from a donor-advised fund. Because with the donor-advised fund, again, the donor has the expectation and can legally expect to be the one to appoint or decide who is the advisor. But anyway, committee-advised funds, that's another way you can get donor participation in the grant-making decisions. You do, again, with these type of funds, have to make sure they are clear on the limitations of their advice, and that, as with all advised funds, donor-advised funds or committee-advised funds, the foundation has the ultimate say-so in the grant-making decisions. Corporate board participation. Board members of a corporation can participate just as employees of the corporation can participate. But again, they need to understand that once that fund is established and the gift has been made, those assets belong to you at the community foundation and no longer belong to the corporation, and therefore are not under the legal control of the corporation. All right, so a little bit more about donor-advised funds when you have a corporate donor. Donor-advised funds, as we all know, have their own special rules, and they include a prohibition against grants to individuals. If the donor-advised fund is going to make grants to non-charities or private foundations, you at the foundation must exercise expenditure responsibility, which is an extra set of due diligence steps to ensure that the charitable dollars are used for a charitable purpose. Donor-advised funds, distributions from donor-advised funds cannot result in any benefit to the corporation or related parties. So a distribution out of the donor-advised fund cannot result in a financial or other type of benefit to the company and to related parties. And the code defines related parties in the corporate context would be individuals who govern the corporation by virtue of sitting on the board, who have a 35% or more ownership in the corporation, family members of those types of individuals, but it would not include, in many cases, all of the employees of the corporation. So the fact that the donor-advised fund may be making a grant to a charity where an employee's spouse happens to work is not going to be a violation of the donor-advised fund rules if that employee is not considered a related party because they're not in the top management, they're not on the board, they don't own 35% or more of the company. If they're just a general employee without any ownership interest in the company, those types of incidental relationships are not going to result in a violation of the donor-advised fund rules.
So an example might be the donor-advised fund wants to sponsor or support a gala, or support a fundraising event that the community is hosting. Where can that go wrong? What's the...
Yeah, that's it. That's a good scenario. So right. So your corporate donor has a donor-advised fund, and they hear that the hospital is holding a gala to raise money for a new wing to be built on the hospital, and they're very interested in supporting that. So they come to you as the donor advisor, and they say, we want to make a grant from the donor advised fund to the hospital gala. We want to make a $50,000 grant out of our donor advised fund to the hospital gala. Now, all the donors to the hospital gala are supposed to receive a table at the gala, right? They'll receive tickets, a table of 10 seats at the gala. Now, we know that donor advised funds, distributions from donor advised funds cannot result in a benefit to the donor or the related parties. So in this case, you could make that $50,000 contribution, but the corporation would have to decline the table because that is considered a benefit. And if the corporation is thinking they'll make the $50,000 contribution and then use the table to allow their corporate executives to go to the gala for free, that is an impermissible benefit back to the donor. So that's a good example and not an uncommon example of grants that may be made from donor advised funds.
Question about private foundations. One of our attendees asked about grants that are made to private foundations obviously require the expenditure responsibility. Does this apply to both private operating and private non-operating foundations?
That's a good question also. Private operating foundations, and there's a specific definition of what is an operating foundation, and in a very simple terms, it means that you're using almost all of your available assets to run a program, and the threshold is 85% under the code. So if you're a private foundation and you're funded by a single family or a single company or single individual, but you run a program, you run a museum, you run a nursing home, something like that, that's charitable, and 85% or more of your available assets are going to run that program, then you can be considered an operating foundation. And private operating foundations are actually treated more like public charities. So that is an exception to the expenditure responsibility rule, in that if the private foundation actually meets that definition, you would not have to do expenditure responsibility. All right. So I want to move on now to another question?
I'm still here. All right.
Okay.
Well, this was a good, it's the same vein, so I didn't want to leave it.
Oh, okay. Yep.
This is about going back to the donor advised fund. So
okay.
What about a golf tourney example? No tables, no tickets, but just a logo on the big screen, or T-shirts, or some type of essentially an ad that's going to be going to the program. You think about it from a sponsorship standpoint.
Yeah.
What's that?
Yeah,
what are we walking on that?
We do have some IRS guidance on that, and IRS says that donor recognition by display of the donor's name, and in this case it would be the company's name, the company's logo, those types of things are okay because they're simply recognizing the donor as a contributor to the event. Now, if that recognition crosses the line to actually be advertising, then the IRS views that as something of value that the donor is getting, and that's impermissible. And they do kind of help us figure out what is advertising. There are some guidance that says that if you're using comparative or qualitative language regarding specific products and services, that's advertising. Links to the company's web page is okay, but links to specific product pages are not okay. So it's kind of a collection of guidance we've gotten over the years to say what's advertising and what's just donor recognition. But donor recognition is okay, advertising is not, and if you have a situation where you're not sure, just feel free to reach out to us, and we can look at the facts and compare to the IRS guidance. Okay, so if we can move on to employer-related scholarships, because this is a very popular topic here at the council. We get a lot of questions in this area, and I just wanted to explain kind of the origins of this. We have IRS guidance. We actually have some very specific rules from the IRS on employer-related scholarships. And when we're talking about employer-related scholarships, it's not merely that the company is putting in the money for the fund. It's that part of the criteria to be eligible for the scholarship is that the student is connected somehow to the company. That's when it's an employer-related scholarship. It's not about the funding. It's about whether the criteria or the eligibility for the scholarship requires a connection to the employer. So you can have the employees themselves or employees' children. If the criteria to be eligible for the scholarship requires that connection, then you have an employer-related scholarship, and then you have to worry about these rules. But the rules originated because there were companies out there who started private foundations solely for the purpose of awarding scholarships and particularly awarding scholarships to their own employees. And scholarships is generally a charitable activity, and so all was going well, but the IRS started to be concerned that these employer foundations that were solely operating to award employee scholarships were really being used as a tool to recruit and retain employees and as an employee benefit. So the IRS published a revenue procedure way back in 1976 to address this situation. And this revenue procedure, 76-47, is a 6-page long revenue procedure which talks about the rules on how you can do an employer-related scholarship. And yes, it was written for a private foundation, but we at the council feel that it's important for community foundations, even though you're public charities, to be, one, to be aware of these rules, and two, to try and follow these same rules as best that you can to keep safe, to be within the guidelines and the spirit of what the IRS is trying to do. You don't want to be in the position of facilitating a company getting around these rules by using you and your foundation for their scholarship fund, because if they were to do it themselves, then they would be subject to all these rules. So that's why the council has for years and years recommended that even community foundations, even though they're not private foundations, they adhere to these private foundation rules for employer scholarships.
And which revenue procedure number was that?
It's revenue procedure 76-47, and if anybody wants a copy of it, I email it out almost weekly to different people who ask for it. I'm happy to send it out by email to anyone who wants it. And it's actually a very easy to understand revenue procedure. It really lays out the rules for employer scholarships. And it talks about the selection committee, and it essentially prohibits the company from controlling the selection committee for the scholarship. It talks about how to ensure that the scholarship is really competitive and not just an employee benefit or a reward for employees. It talks about the criteria and how the criteria need to be objective and applied fairly to all the applicants and not to be used as a way to reward favored employees. There is a percentage rule, and this goes to the competitiveness. The revenue procedure lays out the rule that you can only award 25% scholarships, up to 25% of those who have applied for the scholarship. So if you have 4 students applying for the scholarship that year, you can only award 1 scholarship. There is also a 10% rule, which is kind of a fallback rule if you can't meet the 25%. It's a little bit more strict as to the facts and circumstances. But again, this is designed to ensure that this is truly a competitive scholarship based on the students' achievements and merits, and not just simply a blanket benefit that the company is trying to give to all their employees. If that were the case, it would be employee compensation or an employee benefit plan, and not a charitable scholarship. And this is really important to the IRS. So it's important that you know these rules and try to follow them.
So I just shared this with one attendee. If you Google scholarship rules, 7446, you can find that document online as well as related articles. We'll do our best to try to remember to send it because some people have been asking about it. There was a question in particular to this. If a corporate, and I think we might have answered this, but just to make sure, if a corporate scholarship program is advertised outside the employee pool, can it avoid the employer-related scholarship status? How substantive does the outside eligibility need to be to avoid that?
Yeah. I think it's in the same revenue procedure. If not, it's in other IRS guidance. But the IRS has said that if you have a scholarship fund that's funded by a company and it's wide open to any students in the community or any students from a particular school, that is not an employer-related scholarship. However, if the criteria says something like it's open to all the students of a particular high school with a preference for those who are the kids of employees of this company, that will be treated like an employer scholarship. Just saying a preference is still part of the criteria, and therefore they view that as still employer-related. So that's a great way to get out from under these rules, is to encourage your corporate donor to open up the scholarship to students in the entire community or students from a specific school, and not limit it to just children or employees, children of employees or the employees themselves. And particularly if it's a small company, you're going to run into issues with that percentage test. If it's a small company and not a lot of students are going to be applying each year, you could have difficulty even meeting the 25% test. So that's when you might want to talk to your corporate donor and say, look, we're really having difficulty getting qualified candidates to award the scholarship. Why don't we open it up to students attending your favorite university or students attending the high school that is in the area where your company is located. Opening up the pool is helpful for a lot of reasons, but it can get you out of the employee scholarship rules, and it can also best utilize the fund assets.
Thank you, Suzanne. We've got about 8 minutes or so, and we've got 2 really good topics yet to explore. So thank you for taking the time to what we know is an important topic on scholarships.
Okay. So kind of along this same vein, we've got questions. We get questions regularly about employee assistance, hardship, and disaster funds. And these can be tricky. They're very similar to the employee scholarship funds in that it has to be objective criteria. It has to be, I don't want to say competitive, but it cannot be used to simply provide additional compensation to employees or as an employee benefit. So one of the simplest ways to do this is to limit the assistance to instances when there is a declared disaster. If there's a state or federally declared disaster, then there's no question that individuals who've been affected by this can get charitable assistance. So your corporation can set up a fund where they provide assistance when there is such a declared disaster. Now, fortunately, those things don't happen all that often, and so you could go years without a situation where you would be making any awards from the fund. In which case, you might want to broaden it a little bit to include other types of hardships or emergency type situations. This gets a little bit more tricky because you really need to hone in on a good definition of what is a hardship. And we don't have a very specific definition from the IRS, but it's generally considered unpredicted, emergency type situations that are beyond the individual's control and for which they've suffered a financial loss that's not otherwise covered by other sources. So a flood, a house fire, an auto accident, a terrible illness, these are the kind of things that if the employee, the individual, has financial hardship that's not covered by insurance or other sources, they may be eligible for assistance from an employee hardship fund. But again, it's really up to you guys working with the corporation to come up with a really solid, objective definition of what those types of hardships would be, and then also to come up with an application process or an evaluation process that objectively evaluates individuals who are applying for assistance from the fund and making sure that they meet all the criteria and then making the awards. Similar to the scholarship funds, you don't want to allow the company to control the selection process. That's something that you guys need to be doing at your foundation, and if you don't have the capacity to run that type of program, it may be something that you decide not to offer to corporate donors. Financial need is another, again, important part of this. The hardship, we've had questions where there have been tornadoes and hurricanes and things that have destroyed property and created hardships for individuals, but they have their own means to mediate those problems, whether it's insurance or other assets that the individuals have. So financial need is generally a very important part of the criteria, and the purpose of the fund and what makes it charitable is that you're helping people in need that don't have any other options to help make them whole. One other note about both the scholarship funds and these hardship funds, and particularly hardship funds, it's tempting for corporations to approach a community foundation to set up a fund right after there's been a disaster or something has happened. And the thinking is we'll open up the fund, we'll take in contributions, we'll award assistance to those in need, and then we'll close it and it'll be over. But the IRS wants to see a fund that is ongoing. Otherwise, they view it as an attempt to help a pre-selected group of individuals, and that, in the view of the IRS, is not generally charitable. If you have a group of individuals, a group of employees that have been harmed by a particular incident, a disaster, and you're really just raising money for them, and then and when that's over, you're going to close the fund, that's pre-selection of those individuals, and that's not charitable in the eyes of the IRS. So if a company approaches you with wanting to establish one of these funds, you really need to encourage and make them understand that this needs to be an ongoing commitment. It's not something that's a one and done once the disaster is over, but that it needs to stay open and available for the next incident and into the future, because that's what's going to make it a charitable fund and not just an attempt to help certain individuals. I think, is this my last slide? Yeah. All right, so we're now on the last slide, and this is just a couple of notes about tax reporting of charitable assistance, because these are the kind of follow-up questions I get a lot in this subject matter. So if it's done properly, the charitable assistance, the scholarships, the hardship grants that you make to individuals are considered charitable and are considered gifts, and therefore they're not taxable to the recipient. So the recipients don't have to worry about claiming that as income. You don't have to worry about any tax reporting. Scholarships are the same, that for scholarship money that's used for qualified educational expenses are also tax-free, and no special reporting is required on your part. For scholarships specifically, even if there's portions of the scholarship award that might be used for things other than qualified educational expenses, you know, if they're using part of the scholarship award for living stipend or things that are not your tuition, your books, your fees, that may be taxable to the student, but you as the community foundation are not responsible for providing them a 1099 or reporting to the IRS. The instructions to IRS Form 1099 say clearly that you have no obligation to provide a 1099 for scholarship payments. You do, however, have to report on your annual Form 990. There is a question on there that asks if you as a foundation are making grants to individuals. And if you are making scholarships or you're making hardship grants that are being paid to individuals, you would have to report or answer yes to that question. So the IRS can know if you're doing that, and that can, and if they have any questions, they can come back and ask you about your scholarship program or your grants to individuals.
Quick question for you, Suzanne.
Yep.
In a medical hardship situation, is an employee allowed to come back for a second grant, assuming that the very serious nature of their need continues? So can they come back for a second grant?
Yeah. There's nothing to say that if the medical situation is ongoing and they receive some assistance from the fund, and a year later they're still dealing with this and they need some additional assistance. Yeah, there's nothing to prevent coming back for another grant. It's just that it has to be, you have to follow your application process and apply the criteria in an objective way against anybody else that would also be applying for that. So,
well, lots of fun. Good question. Thank you, Suzanne, for your excellent insights and helping us think critically about corporate donors, how we engage them at the Community Foundation, helping us think through the rules, the regulations, and perhaps ways to navigate around some of the issues that certainly come up when working with any type of donor, but particularly corporations. We're out of time, but we certainly do appreciate your participation. I will be following up with the slides and some further instructions, but we're always here for you. We have our information up on the screen now in terms of how you can reach me or Suzanne at any time. Of course, we've got a lot of excellent resources that hit on these various topics at cof.org. And you can always email your questions directly to legal@cof.org, and that inbox is monitored very closely by Suzanne, Brian, and her team, and they are eager to see what you come up with. So thank you, everyone, and have a great rest of your day.
Thank you all.